The funny part is it's like the Bitcoin white paper was wrote in like perfect English. So that's the hard part about it. You'd had to have, there's only one person's analogy that I've seen. Hyperinflation. Oh, Joe's got some good content. He's probably got another banger out today, yeah.
What's up, everybody? Joe Brown.
Jeez, Joe. Why are you yelling at me?
Down here, this is the Heresy Financial Show, and you know I promised that as soon as I saw anything change in the housing market, I would let you know, and that is this video. Today is that day. We are going to be looking at the first bearish signs that I have seen in the housing market in years. Now starting to see some things that are a little bit concerning, but make sure you hang along until the very end because there is a big but that I am going to show you about the housing market as well. Make sure you stick around for that big but. Ready? Let's dive in. Today's sponsor is Masterworks. Masterworks, you've heard me talk about them plenty of times on this channel, and they are revolutionizing the way that the average everyday investor can invest in contemporary art. Again, this is an asset class that used to be reserved for the ultra wealthy because if you're going today. All right, so this is the first time in years that I have seen housing data come out that makes me think, oh, things could be turning around here. The first time I've seen some concerning data. So the first thing that we are going to be looking at is inventory. This chart from the Fed, obviously there are many different sources of this same data, but this chart is the one that many people are concerned about right now. We are seeing inventory spike. It is just accelerating very quickly here. If we zoom out, you can see that this is just a very quick spike recently with inventory shooting up to 9 months. What is this figure? This is the number of homes that are currently for sale divided by how fast homes are selling, and that comes up with your number of 9, saying at the current pace that houses are being sold, it would take 9 months to get through the current inventory. For the last couple of years, this number has been extremely low because there's been so little inventory that houses are just getting sold and sold and sold. As soon as something comes up on the market, it gets sold within a couple of days, couple of weeks. And so this number has been extremely low, saying, hey, if there's no new homes that hit the market, we'll get through all the for sale homes in like, a couple of weeks or a couple of months. Now that number's at 9 months. So we have inventory spiking in terms of months of supply, which means that houses are staying on market for longer and less people are buying, more people are selling. We're seeing 9 months worth of supply right now, and that number's changing quickly. Inventory's going up fast. Second thing is that home prices are still going up. You're going to see why this is included in the bearish case for real estate right now. We are seeing housing prices are still soaring. The median price of a new home in April was $450,000, which is 20% higher than April of 2021. So home prices are still going up, and that is pricing out buyers from the market. That is contributing to the inventory going up. But it's not just home prices still going up that is contributing to the inventory, contributing to homes not being sold. It's also the fact that mortgage rates are still going up. We've obviously had a recent little dip here because of what interest rates have been doing, but you can see this massive spike, historically speaking, in mortgage rates, and that has contributed to a massive increase in the cost of purchasing a home. If the price has gone up and interest rates have gone up, that means your principal and your interest portion of your payment is going to be a lot higher. just in the last couple of months on the same home, you've seen a payment go from something like $1,500 per month to $2,100, $2,200, $2,300 per month on the exact same home, because the average prices have gone up and the interest rates on the mortgages have gone up. And so we are pricing so many buyers out of the market right now, they just can't afford, especially these higher priced homes. And then finally, they're all kind of tied in together, looking at things from the same, from different angles, but sales are tumbling. If we look at newly built homes, sales tumbled 16% in April. And so of all the new homes that are being completed, sales of those homes are dropping very quickly. Part of that is because of how expensive they have gotten. The median US new home price divided by the median US household income is higher than ever. This chart goes back to 1967 here, and we can see that the price of homes has continued to go up relative to household income, and this is new homes. This is again because the prices have gone up and interest rates have gone up, and so the price of those payments is going to go up faster than incomes on average have been going up. And now for the big but. We are going to take a look at all of these bearish arguments and see if they hold water. We always want to look at all sides of the argument, make sure that we're being rational about the way that we're approaching this. So let's take a look at inventory. This chart you can see from tradingeconomics.com shows the total inventory of all homes for sale across the nation, and we can see here that yes, inventory is spiking, but in terms of relative to history, that's not really considered a spike yet. So at this point, you're probably asking, but wait a second, what was that other chart then that we just looked at that showed inventory was spiking? We were looking at this one, which is measuring inventory in terms of how many months it would take to get through the current supply. So today, if all the buyers dried up and literally everybody stopped buying homes, you didn't have a single sale take place from this moment forward, if you only have one house for sale, it's never going to sell. That means inventory is infinite in terms of how many months it would take for all of the inventory to get worked through. And so when buyers drop off of a cliff and demand goes to zero, that month's supply number is going to spike. So obviously you're going to see a spike there. So what we are seeing right now, looking at total inventory, we are not seeing panic selling. We are not seeing everybody list their houses on the market right now. In fact, we are seeing a very little change in new listings. What we are seeing is demand drying up. Nobody can afford homes right now. Interest rates have gotten too expensive, especially with the still rising prices. So nobody can afford. That means demand is going basically to not all the way to zero, but demand is dropping off really quickly here. So we're not seeing people panic selling. We're not seeing a massive increase in people selling like we saw in 2007, 2008 when inventory new listings were just way up here. We are seeing a seasonal spike in inventory here like we always do every year, but we are not seeing anything abnormal. What we are seeing is lower demand. So why does that matter? Well, it matters because we are not seeing panic selling. We are not seeing forced selling. We are not seeing a bunch of people forced to put their homes on the market because they're underwater, because they can't make their payment. Right now, the only people selling their homes are the ones that are trying to capitalize on timing the market and selling at the top, which they probably missed it by a couple weeks, maybe a couple months. So they're going to get discouraged. We are starting to see more and more of an uptick in prices being reduced. We are not going to see a massive wave of people panic selling here. In fact, if homes sit on the market for too long, what we are more likely to see is people taking their homes off the market. If you think you should be able to sell your house for $700,000 because your neighbor did 2 months ago, and now you list it for $700 and you get 0 bites, you drop the price to $680, you get 0 bites, you drop the price to $650, you get 0 bites, and maybe you think, hey, well, I only bought this house for $600, I don't want to go much lower. You're not being forced to sell. You very well may likely pull that house off the market, considering, again, you have to live somewhere. So if you sell that house at $640 and then you go and move somewhere else, your interest rate went from 3 or 4% to 5 or 6%. And so you are increasing your cost even if you are going to buy a house that is lower priced than what you currently are selling your house for. So this lack of demand at current prices and current mortgage rates could very well lead to, it's like a battle right now between the sellers and the buyers. No buyers are coming in, but the sellers have a lot of equity. The sellers have great credit. The sellers are not being forced out. They're not being foreclosed on. They're not underwater. And so they're just going to sit tight because sellers have to live somewhere. And so you're going to take that into account. You're going to say, hey, well, if I sell at too low of a price, well, then I'm going to actually lose money considering what I have to move into. And now you're thinking, okay, but wait, what if they don't sell and buy something else? What if they sell and then they go rent somewhere? Well, you still have to have somewhere to live. So that's going to still create a floor underneath the housing market from investors holding rental properties. And the other thing about rental properties is companies. Hedge funds, these massive corporations buying up entire properties, entire lots. They weren't buying these over the last 2 years to sit on them and hold them for 6 months or a year. They're off the market forever. And if Zillow sells a big block of homes, they're selling them to Invitation Homes. If hedge funds who bought up large blocks of homes so that they can rent them all out decide they want to exit that market, they're going to sell that entire block of homes to another company that's going to keep them as rental homes. For the most part, they're not going to be entering the market again. These aren't going to be going to retail investors. They're not even going to be going to homeowners, individual homeowners. They're just going to sell the big block of homes to another company. And you think, okay, but what about all of the home builders that are building a ton of homes right now? Because that's true. We've seen a spike in housing starts. Take a look at this chart from Joey Politano. We can see that, yes, housing starts have been increasing at the same trend that they've been increasing at since 2010, but housing completions have stagnated. They've moved sideways. Housing completions have not kept up, and now that we are seeing demand drop off, we are seeing home builders back off from starts. And so we are seeing a dynamic still at play where there are more people than there are places to live. But the people who want a place to live are right now being priced out from buying a place to live, so they're renting. That's why lower priced homes are still going hot. They're still selling quickly. It's the higher priced homes that are slowing down. So put all this together, what do we have? Very likely we are at a temporary top. Very likely, housing market's been going like this. We are topping out and we could drop 1%, 5%, even 10% over the course of the next year if everything stays the same. Absolutely, that could happen. However, for the housing market to drop 20%, 30%, 40%, something so catastrophic would have to happen. Number one, you'd have to have a massive wave of unemployment because there's so much equity. People's incomes have been going up, even though they haven't been going up with the pace of new home listing prices. Everybody who bought a house within the last 10 years, 5 years, 3 years, their mortgage payment, their house payment is staying the same and their incomes have gone up. And so in order to have a big wave of foreclosures, you need a big wave of unemployment. You need everybody getting laid off. You need everybody getting fired, and people can't afford those payments anymore because they're not underwater. They've got a ton of equity. And so you need to have a massive wave of layoffs and unemployment, which means that for something like that to happen, somebody big is blowing up. A big hedge fund, a big bank, a large corporation. Basically what I'm getting at here is we got another bailout coming. If something like that starts to happen, there's no chance. We've got a snowball's chance in hell of the Federal Reserve and the federal government just rolling over and saying, hey, we will let a depression roll through our economy. Instead, what they're going to do is they're going to bail it out again. We know that's what they're going to do because that's what they've done every single time for decades. Anytime something crazy happens, they stop the depression, they stop the recession, they stop the crash from happening. And for a crash in real estate to happen, something else even larger and quicker would have to happen first, which means that if you want to try and time this thing, it's possible over the next couple of months, you'll be able to find a deal. It's possible prices will come down. If you wait too long and you aren't already in the real estate market, you might be priced out of the real estate market forever. There are a lot of people who have been waiting for the dip, waiting for the next crash, and are now priced out. And now they're stepping back and saying, well, I can't afford anything now. I was waiting for the crash that never came, and now prices are higher than I can afford. So they're waiting for things to crash, waiting for things to dip, and they'll get back in. They'll get in. But for the ones who don't, we are going to skyrocket. Next time something crazy happens, the Fed will step in, the bailout will happen, interest rates will get pushed down to zero. They're going to come out with a 40-year mortgage. They're going to come out with more first-time home buyer assistance, down payment assistance federally, and that's going to shove housing prices right back through the roof. And anybody who doesn't, in my opinion, get into the real estate market with anything, whether it's a cheap home, an expensive home, an investment home, something, at least getting your foot in the door, anybody who doesn't will be priced out of the market forever once it starts to go back up. So in my opinion, we've got at most a year to get in. We've got some deals coming up probably, but maybe you don't want to try and time the exact bottom, because somebody could blow up tomorrow. Somebody could blow up next week. Somebody could blow up next month. The bailout could happen at any time, depending on how big the risk is pent up in the system right now. We just don't know how big the risk is. So in my opinion, better to be safe than sorry. At least get your foot in the door. And yeah, over the next couple of months, it's very likely we see some deals. And for anybody who doesn't get in, you may never be able to get in at all. That's what I'm seeing in the real estate market right now. As always, if anything changes, I'll let you know. Just like I said, this is the first time I've been saying, hey, I think we have a chance for housing prices to come down. I've never said that before. Now the data has changed. Now we're looking forward, and it looks like, yeah, we actually might have a dip in housing price.
All right, so he's saying that. Now check out Steve's video. We watched this one yesterday, so I'm just going to play a piece of it. But Steve's more convinced that we... Man, I cannot wait, guys. We're going to go to the effing moon when they start that bailout. Like, come on. Somebody got to fail soon. The sad part is that when they reverse course, we going up. And we going up hard. And it's going to be rough. Oh, yeah. Steve's got a video on the bond thing that I was reading, I think, on the Wall Street Journal, too. So we'll watch that here in a second.
The housing bust just started as sellers slash prices. I'm your host, Steve Van Meter, and thanks for joining me today. And sellers are telling their realtors to get me out now as they believe prices has peaked and the bubble's about to pop. Let's head over to CNBC where we picked today's story up as home listings suddenly jump as sellers worry they may miss out on the red-hot housing market. Sharply higher mortgage rates have caused a sudden pullback in home sales, and now sellers are rushing to get in before the red-hot market cools off dramatically. Can't afford it, and as you know, what does that mean for bonds? Well, that means interest rates are coming down and bond prices are going up, because when you see these backups in yields, what happens? And we've talked about this on the show a number of times. They lead to new all-time low in yields. And why is that? Well, yields have to fall far enough where people will demand credit again and they will want to borrow. And where did most of the borrowing happen at this cycle? Well, it happened near the lows, and that's why you will see rates eventually come crashing back down. If we look at home buying conditions here from the University of Michigan Sentiment Survey, now there's three lines here. There's the blue, which is in houses, and red, which is vehicles, and gold, which is durable goods. But look at the blue line. You know, it's down here in the 1980s to 1984. You know, this was a period I, as a child, saw homes sit on the market for over a year, and no one would come look at them. Or if someone did, there was no offer, no buyers. And now look, demand for housing in terms of sentiment is collapsing at those levels, suggesting that, as we talked about, buyers are tapped out. This isn't a market they can afford, and they are going to drive where prices are going, and sellers are going to have to be forced to lower them. The sooner the better. And what other catalysts do we see? Look at the new one family houses sold in the United States. This is a fantastic data series by the Federal Reserve, St. Louis Federal Reserve Branch. And notice that you see one home families one family home sales rising, and then they collapse, coming into recession, collapse, coming into recession, collapse. And now look, you see in the pandemic, because of low rates and all that fiscal stimulus, what happened? Demand for homes surged, and people wanted out of the city. Get me out of here, put me out in the country. And now all of a sudden, the inevitable collapse is actually starting. And what is the catalyst? Can you imagine? Check this out. We've got the Wilshire 5000, which is a total U.S. stock market on a year-over-year rate of change. And notably, when the wealth effect goes away, well, what happens is home sales start to come down. You see, here's some good examples going back into the late 80s, early 90s. The stock market starts to come down. The real estate market sales go down. Look here, the market comes down, and you see home sold go down. Market starts to stagnate and fall, and home sales come down. And you see it right here again. The market is a leading indicator of this wealth effect. And you think about where people get their down payment from. Maybe it's not them, maybe it's from their parents. You think about how they're posting collateral to show the lender that they can afford the house. Well, if their net worth is going down, well, so is their ability to buy a home. But these signs were pretty obvious. Of course, when we start looking at other data, we can see it. But there's one thing that shouldn't be going down when the housing market blows up. That's your portfolio. Be sure to check out Portfolio Shield. I'll put a link up here in the corner and in the description below. Let's continue on, because we knew this was eventually coming as U.S. pending home sales dropped for a sixth straight month, and the worst skid since 2018, as contract signings decreased 3.9% in April from a month earlier. Pending contracts are telling us they'd better reflect the timelier impact of higher mortgage rates than closings. Home prices in the meantime appear in no danger of meaningful decline. Well, we'll see about that. Now, a pending contract is simple. Let's say I put my house up for sale and you put an offer on it, and you sign it and I sign it. That is a pending contract. Doesn't mean that you can't back out or I can't back out. It just means we now have a pending contract. And those are a great leading indicator of where the market is going. And how about previously owned home sales? Now, these are completed contracts. They fall to the lowest since June 2020 as existing home sales dropped a third month in April. And when sales drop, well, prices are soon to follow as contract closings decreased 2.4% in April from the prior month to an annualized 5.6 million units, figures from the NAR. The median forecast in Bloomberg survey economists called for 5.64 million. So once again, experts missing the mark, as higher home prices and sharply higher mortgage rates have reduced buyer activity. It looks like more declines are imminent in the upcoming months and will likely return to the pre-pandemic home sales activity after the remarkable surge over the past 2 years. And that is rosy optimism right there, because that implies that buyers are just slightly priced out of this market. In reality, they're completely getting priced out of this market. Cash sales represented 26% of all transactions in April, down slightly from the prior month, but still elevated. Investors who typically buy up in cash and are therefore less sensitive to mortgage rates made up 17% of the market. So again, we're seeing still a lot of speculation in the market. And of course, we know what happened in the great financial crisis when too much speculation ran rampant. People said prices couldn't fall. Well, they did, and a lot. But how about new home sales? We see in April the biggest monthly drop since 2013 as sales fell 16.6% last month as mortgage rates make ownership more expensive for buyers. And this is the same story over and over as new home sales, which make up more than 10% of U.S. home sales, something nobody said was going to stop, are tracked when contracts are signed, while existing home sales are tracked when contracts are closed. That makes new home sales a leading indicator of where the market is headed. And all these indicators are telling us that it's time to get out now.
So yeah, that's about it. That's about those two right there. So, you're looking at what's going on around the world. It's hard to say, I hope this is it, guys. I really do. Solo miner bust. Yeah, that's pretty crazy, to think about. As long as your PC has the ability to solve one algorithm, one hash in 10 minutes, yeah, you have a potential of mining a block. I mean, it's statistically how many hashes are miners solving per block? Yeah, so tiny Bitcoin miner defies massive odds to solve a valid block. Despite having a modest hash capacity of 126 terahashes, the lucky miner won the crypto equivalent of the lottery and took home 6.25 BTC worth $266,000. A single Bitcoin miner from a solo CK mining pool has defied the odds successfully after adding a new block onto the blockchain, taking home 6.25 BTC for their efforts. Their lucky miner, who may have been mining just one or two machines, solved the block with their modest hash rate of 126 terahashes per second. According to Tuesday's tweet from a solo admin, is equivalent to a 0.000072% chance of the total Bitcoin network hash rate being at 175,000 terahashes. So Bitcoin mining experts and members of the Bitcoin Mining Council told Coin Telegraph that it has never heard of anything like it, adding to it saying that it's very rare and to say this is very rare is an understatement. Usually having a 0.0% hash rate means that on average solo CKs win 0.072% of blocks, or 1 out of 1.4 million, he explained. Because that's what they don't want, right? Like that's what the mining farms don't want. They definitely don't want everybody thinking that they can solo mine. And that's what's different with Cardano. And that's what's extremely, extremely awesome about Cardano. As you can set up solo miners and have statistically, because the hash rate's not that high in the network right now, really good odds, I think, at solving blocks and solo mining on Cardano. And people don't really realize, like, it's all about blocks on chain, guys. Like, most of the world doesn't realize what Cardano actually is or how powerful Cardano is going to be because, one second.